All right, we're half an hour away from the open of Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with Annabelle Droulers.
Our top stories: Asian stocks rise after Wall Street hits a fresh record high fueled by a rally in chip makers. Nvidia surging past Microsoft to become the world's most valuable company.
And China sovereign bonds in focus after a buying frenzy lifts futures to a record closing high yesterday. That's despite scrutiny from authorities.
And the U.S. ramps up efforts to restrict China's access to chip technology with a new bill in Congress and a senior official sent to enlist allies' help.
Well, it was that everything rally that reignited itself in the U.S. in certain ways, and you're seeing some of that tailwind come through to the Asia-Pacific, but not so much really. It is a little bit more mixed in terms of the equity space here, but we're still seeing some decent gains across the region here today. U.S. futures are still slightly higher. It was that retail sales number out of the U.S. that did show finally maybe signs of cooling in the U.S. consumer that really helped in some ways reignite those bullish bets on treasuries once again, which basically just last week people were abandoning that call before that CPI print, before that Fed meeting. So obviously with U.S. markets shut for Juneteenth, though, we were not tracking treasuries in Japan here today, but bond futures are still slightly in the red here. We're not seeing a whole lot of movement across the sovereign bond space here this morning, but we're watching Taipei when this opens up. Take a look at that. 1% pop there. I'm guessing the likes of TSMC is really helping that, thanks to Nvidia, again, helping the S&P reach that 31st record of the year. It's becoming the world's biggest company now, surpassing Microsoft and Apple to be a $3.3 trillion company. So certainly that's lifting basically most of these semiconductor stocks here across the region. Take a look at TSMC. We're up close to 2% at the get-go here. Wistron's also doing well in Taipei. SK Hynix, Advantis, all of which get revenue from Nvidia, also all doing well. We'll watch how these Chinese chip makers fare once things open up at the bottom of the hour. But take a look at how the setup is, right? It's not so much a stock story really in China. It's really going to be about what's going on in this bond space, right? Take a look at what we're seeing. We're seeing that Chinese 10-year yield close to those decade lows, 2-decade lows, I believe, 225 for your Chinese 10-year yield. We talk about those bond futures hitting a record yesterday, and this is despite, traders are not listening to what the PBOC or other policymakers are saying, that this rally in the long end has gone too far. There's another auction coming up later on as well. Futures, though, are still pointing positive, Belle.
Yeah, Yvonne, it really just seems like investors cannot get enough of bonds at this point in time, but we will get a bit of a better sense, really, of that appetite when we do, as you say, have that special auction coming up. So it's around 45 billion worth of yuan worth of 20-year notes that are going to be auctioned, that coupon at 2.49%. Otherwise, what we're tracking in the session, actually, with all of that optimism around Nvidia, for the Hong Kong space, it's a pretty different story. You're seeing lower volatility coming across lower trading volumes as well. So we've actually got the Hang Seng Vol Index at 20. You've spent much of the year really around that 25, 26 on average, and trading volumes, as I said, thin. Yesterday we're off 20% roughly of where we would typically be on a 3-week moving average basis. Geopolitics-wise, also that's something to track. You've got Li Cheng that's arriving in Malaysia for a visit. First time we've seen a Chinese premier there to a Southeast Asian nation going back to 2015. We've got the Lujiazui forum kicking off in Shanghai. We're going to be hearing from the heads of the CSRC, PBOC as well, so we'll be watching for any lines from that. And of course, that window for FDI data still very much open and really wanting to get a sense of just how much foreign investors are interested in China, given you've seen such a slump so far this year.
Yeah, so certainly that's going to watch. I mean, those two, Wu Qing as well as Pan Gongsheng, probably the most, the two people that the market really wants to hear from here, whether it's about market reforms, whether it's about where monetary policy lies here. Are we likely to see a little bit more of those rate cuts later on in the year? Let's talk a little more about our top story this morning. Nvidia becoming the world's most valuable publicly traded company as the AI rally propels the chip maker over its mega cap tech peers. Our senior tech executive editor, Tom Giles, is with us out of San Francisco. Tom, it was a matter of time, I guess, that we would reach this milestone. But, what's driving this latest leg higher for Nvidia, you think?
Wow, this company has just been on a rocket ride for a really long time now, but it has really accelerated in the last couple of years with the generative AI boom. This company, led by Jensen Huang, has been at the forefront of some really important cutting-edge technologies at various important junctures over the years. And I just want to walk you through those very, very briefly. Early on, they pioneered graphics chips that made video games and video game experience really realistic and really come to life. And it kind of built out this niche. I remember for years we've written about them as, oh yeah, they're the leader in graphics chips that are used in consoles and really make the video experience come alive for people. And then they got into, more recently, they got into data center chips. These are the things that are powering the servers that power the data centers that all of our companies rely upon. And then more recently, you've seen them branch out and get into things like autonomous vehicles and some other niche areas. And then finally, the most recent boom has come in the years since 2022 with the advent of ChatGPT and the realization that generative AI, the likes of which you see with ChatGPT by OpenAI, and lots of other chatbots that are being created by the biggest tech companies right now, NVIDIA's chips are basically at the center of those.
Yeah.
It's not just chips, of course, and the GPU focus, because anyone from Nvidia will tell you that they're a full stack solutions provider with networking, with software as well. Do you think that side of the business is fully appreciated as yet, or could we see further gains based on that from here?
I think that really people are focused on the role that these chips play in the data center and the role that they play in really kind of giving light to the generative AI boom. You don't hear as much about things like software for NVIDIA. I certainly think there's a possibility for you to hear more about that in the coming years. The other thing that we have to remember with NVIDIA is nobody stays on top forever. There's always a competitor waiting in the wings. We're waiting to see, for example, how AMD does with its accelerators, which are the NVIDIA competitor. It's very, very early days for them, but it is something that I think investors are keeping a very close eye on. AMD, led by Lisa Su, is also wanting to get into this space. They're being very ambitious about it, but again, it's just the very earliest stages of that entry.
All right, that was a Bloomberg senior tech executive editor, Tom Giles. Thanks very much for those insights. And of course, it wasn't just the story of Nvidia, although that did really take a lot of the attention in the market. But we still heard a lot really from Fed officials on the day prior as well, urging further about this need for patience and giving a few more clues really on when we can expect to see some cuts. So we heard from the president of St. Louis, as well as the Fed governor, Adriana Kugler, all telling investors that they'll have to wait longer for rate cuts.
We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at one or two rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both.
I believe economic conditions are indeed moving in the right direction. If the economy evolves as I expect, it would become appropriate to begin easing policy sometime later this year.
Let's bring in our first guest. Jenny Zeng is APAC Fixed Income CIO at Allianz Global Investors. It seems like all of a sudden the positioning around treasuries is long again, and these fears that, potentially we could be higher for longer, that seems to be kind of fading a little bit. I mean, is that the right call? Should we listen to the Fed?
Well, if we really listen to the Fed, according to the last statement, there's a notable change of wording that instead of saying there's lack of further progress, they changed the wording into there is moderate further progress in bringing down inflation. Now, the combination of a positive supply shock from immigration and also the cooling labor market, as well as restrictive monetary policy, will continue to put pressure on inflation. Right? So if so, that's enough to keep Fed to an easing bias. Right? So whether we're talking about one cut or two cuts, I mean, the room for divergence is not really as big as beginning of the year. And this is the reason we are staying with one cut as our base case. But we think that going into the second half of the year, instead of Fed policy being in the center stage of market volatility, of driving market volatility, we actually think should be political noises.
Oh.
Yeah.
And those political noises, of course, around the US election. But what exactly are you expecting here? What's the level of Treasury market volatility that we could see?
We actually think the volatility of the U.S. Treasury market should come down significantly if you think about the trading range per se. Because again, having said that, there's only 6 months left in the year. Like we can debate it's one cut or two cuts, but that's about it, right? But we need to be aware that there could be much more noises coming from the U.S. elections. We already started to see the market volatility brought by, for example, the French headlines, right, and the Mexico elections, the Indian election results. That could be the center stage of driving market volatility going forward.
Do you think that spills over to the Asia dollar bond space? We've seen that do very well these days. Can spreads actually tighten further, or do you think they can actually widen a bit now?
Well, Asian has been doing really, really well on account of 4 points, many. I think number one is Asian overall compared with the other OECD countries has a much more favorable growth and inflation dynamic, right? We see that Asian continues to outgrow other regions, while inflation actually has been trending down. And we think that's going to continue for the rest of the year, so that hasn't changed. And number two is, if we look at Asian credit cycle, I mean, it's quite, I would say that it's quite obvious that most of the U.S. and the European countries are in the late cycle. We can debate how long that late cycle can be this time, but it's quite obvious we're seeing in the late cycle. But Asia is different. Asia actually is in the more sweet spot of the credit cycle, which is the repair and recovery cycle. Majority of Asian corporates. That hasn't changed, right? So number three is valuation. Like Asian high yield remains the highest yielding high yield market in the world. That hasn't changed despite the outperformance. Number four, China. At the beginning of the year, we're actually much, much less bearish on China. We think that China is a source of alpha. That still hasn't changed.
China, of course. I mean, it just seems like investors really can't get enough of bonds there at the moment. When you've got those yields, though, that are trending to multi-year lows, what are you expecting here?
China, if we talk about the CGB market, it's a slightly different story versus, for example, the Indian government bond market. CGB, the yield is so low. I mean, it's at almost a historical low at the moment. And actually, we think it can still go a little bit lower if we look beyond the very immediate term. The reason for that is mainly because China is in a very different economic cycle. Right? It's not necessarily we're bearish or bullish on economic growth. It's just in a very different economic cycle. Real interest rate remains reasonably high for that cycle. Right? So we think that there's room for China rates to come down, to match to that naturally trending down return in the economy. But it can't go too fast. That's why, the authorities came out and they say, we need to take it slowly in a way, right? But it doesn't change the fact. If we look beyond, if we look into 12, 18 months' time, China HCGB yield will continue to trend down. That's very different from, for example, the reason why we're constructive on IGB market. We are constructive on IGB market because of the carry is so high.
Okay.
But for China, it's because we expect spreads, the yield to continue to go down.
What about for the developers? I'm wondering, because we've seen this rescue package. The data still looks pretty bleak from what we got last week in terms of home prices. Do you think that there's enough incentives there for developers, for banks, for local governments to really kind of revive this housing market now?
That's a really, really good question. Now, let me rephrase that question. So what actually is the intention behind all the policies that we've seen, right? We don't think it's a pivot back to the old model. We actually think that all the measures is the government's intention or overarching strategy to make sure that there's no further tail risk that could unleash systemic issues of the property market instead of reviving the market into the old model, right? So no matter from the banks or the market participants, the developers, they need to adjust to this new equilibrium. The new equilibrium means that the overall physical market, particularly new homes, has to trend down has to continue to trend down, in fact, including construction activities. So they need to adjust their business model. They need to downsize their business, pretty much that. Yeah.
Based on that, then, where do you think that leaves the PBOC going into the second half? Is there room for any sort of cut? And if there is a cut, how low do yields go off the back of it?
Yes, we do think there's room for PBOC to cut. And then now the key constraints, of course, is the pressure on banks' net interest margin, as well as the balance, so that they need to balance the need for FX stability, right? But we do think, again, having said that, the real interest remains a bit high for this economic cycle. And we do think that going into the second half, they will open more room for them to cut deposit rate more aggressively, which will lead to policy rate cut.
You mentioned the cycle in China is a bit different from India. I'm wondering, given that there's a lot of optimism around this bond inclusion in India into the JPMorgan bond indices, how compelling of a case is India, and as an alternative to China in some ways?
Again, the two stories are very, very different.
Yeah.
Why we're constructive on both, the reasons are very different. Let's talk about India. We're constructive on IGB. The yield is one of the highest in Asia. The carry is very high. RBI has done a fantastic job keeping the FX stability. I mean, they have FX reserves at record high, and we think that's going to continue, right? And also, the recent years of India's outperformance in a way can be many attributable to the government's economic reform and also the quality of spending, despite the fact that, in fact, their physical matrix has further weakened. Now, but India, in fact, now has one of the largest local bond market in the world now. The foreign ownership remains very low at 2 to 3%. Right. We definitely think with index inclusion, this can go up. That will further support the technicals of IGB.
All right, Jenny, thanks so much for joining us this morning. That was Jenny Zhang there, APAC Fixed Income CIO at Allianz Global Investors. And, of course, counting down to the open of trade in Shanghai, Shenzhen and Hong Kong, this is the China Show.
Well, the Biden administration is sending an envoy to Japan and the Netherlands, seeking greater cooperation in limiting China's AI chip ambitions. For more, let's bring in our chief North Asia correspondent, Stephen Engel. On this scoop, it's interesting that they're doing this. Obviously, we've seen them try to really tap into the allies to gain more support. But what do we know at this point?
Sure. I think in the first couple of rounds of these export controls by the Biden administration, they did elicit the support from allies like Japan as well as the Netherlands because, again, those, extreme ultraviolet lithography machines are made by ASML and by Tokyo Electron, as well as Applied Materials and Lam Research in the United States. But it's those foreign partners that the Biden administration wants to get more on board as the export controls, I guess, are increased and made more comprehensive. And one of the key components of this would be the servicing aspect. So you might not be able to sell, or you've agreed not to sell these multi-million-dollar machines into China, but the Biden administration wants the governments of these two countries to kind of exert their influence on ASML and Tokyo Electron to not service the machines as well. These machines are very finely tuned and need constant servicing. So that's one of the reasons why Alan Estevez, who is the Undersecretary of Commerce for Industry and Security, will, according to our sources, be heading to Holland as well as Japan to make this case. And more specifically, Yvonne, they're targeting some of the controls on HBM, which are the high bandwidth memory chips that are made with this equipment. And the Chinese competitors like Huawei, like Wuhan Xinjiang Semiconductor and others, they are making great advancements in HBM memory chips. And those are critical. You cannot have those Nvidia accelerators without having the tandem memory chips, the HBM chips. So again, Alan Estevez is going to be talking about this particular machinery to make sure that the domestic competitors in the semiconductor space, which have made those advances that I talked about, do not get a leg up because of that technology.
And it's not just, of course, trying to restrict those foreign players, there's also that way to have coercion through restricting US companies at home as well. So this is a focus for US lawmakers.
Yeah, there's a new law that was introduced Tuesday in Congress, bipartisan, by the way, but also the lead signatory on that bill is a Democrat from Arizona, TSMC, of course, building the plants in Arizona under the 2022 Chips and Science Act. So essentially this legislation would ban, if it would passed into law, would ban any chip company that takes money from the federal plan, the Chips and Science Act, and builds plants. They cannot use Chinese gear of any sorts in those facilities. So you take U.S. government money, you cannot use Chinese gear in that facility. It would not require the same thing for, say, TSMC or others in their plants abroad. So TSMC in Taiwan obviously would not be under this legislation, or their facilities in Kumamoto, Japan, or their aspirations in Europe. But again, if you're taking money from the U.S. government under the CHIPS Act, you cannot use Chinese gear. So it's a further step in limiting China's influence in the chip industry.
All right, Steve, thank you. Stephen Ingle there, our chief Northeast correspondent, on this latest scoop from our team at Bloomberg. Take a look when it comes to how futures are set up, or at least how the pre-market in Hong Kong looks like we are continue to see some gains here, and really joining in on this global equity rally that's really coming through from the U.S. thanks to Nvidia. Here's the Hang Seng up 0.8%. Futures are also punching a bit higher here today, 225 for your Chinese 10-year yield, and still pretty stable currency at 727. Plenty more ahead. This is Bloomberg.
All right, we're about 5 minutes away from the start of trading here for mainland and Hong Kong equities. And you can see here we're just poised to move a little bit higher at the open. Really good session on Wall Street overnight. We marked yet another record for the S&P 500. We saw Nvidia becoming the world's most valuable company. And that just seems to generally be feeding into optimism, because you're seeing that Hang Seng Tech Index there pointing to gains of about 1%, Yvonne, at the start of trade.
Yep, in terms of analyst actions here today, there's a bit on the EV space here as well, or at least the tech space, I should say. Billy, that was an upgrade there from JPMorgan, raised to overweight with a price target of 165. And then also Goldman talking a little bit more about the health space as well. Alibaba Health reinstated a buy, as well as also reinstated neutral for JD Health as well. In terms of stocks to watch, we're watching JD in particular here. So finally 618 has wrapped up, and we got some pretty good numbers that came through. So record sales and orders at the 618 shopping festival. Also talking about JD Logistics as well. So both are doing quite well. Alibaba is also up some 1%. And we're watching, of course, the Nvidia effect once again on these chip stocks as well, particularly some of the ones that are listed here in Hong Kong. There you go. SMIC is up some 1%. A mixed picture, though. ASMPT, though, is heading the opposite direction. You're watching the China show. The open is next. You're watching the China show. We're counting down the open of markets, and it is a bit of a rainy day in Shanghai, but there's going to be a lot of action happening potentially. Lujiazui, of course, this is where the finance world is really kind of centered around what's been going on, and we're hearing the likes of the CSRC head, Qing, is just about to speak at the forum, and really that kicks off here today and goes on till tomorrow. Also expect to hear from the PBOC governor, Gongsheng, as well. So any sort of indication on where rates are going to be, market reforms alike, potentially maybe some new catalysts to this equity market, which certainly it needs right now, Belle.
Yeah, that's right. I mean, you've got that sort of positioning we're seeing in the bond space that tells us that investors at least are expecting we're going to see some further reductions in the months ahead. But here we've got the outlook for equities as well. And as you say, it really has been that shift from investors who are sort of turning more optimistic on Chinese equities, again, turning perhaps a little bit more pessimistic over the last couple of weeks, and those signals of weakness still coming through for the Chinese economy. At the start of the day here, you've got the CSI 300 coming online fairly flat, where, of course, as you said, tracking, do we get any sort of market market-moving announcements out of the Lujiazui forum that's just kicking off this morning. Again, continuing to track what's happening with the bond space, that 10-year yield, you're continuing to see that retreat there in yields coming through. We've seen the 30-year as well, looking to test perhaps, and even being linked to Japan's 30-year yield, which has traditionally been one of the lowest in the world, or the lowest in the world. Otherwise, what we're tracking in the session today, let's take a look at what's happening in the Hong Kong space so far, because it has been that sort of move that we've seen in terms of lower volatility coming through, lower trading volumes. Today, that could change somewhat when you've got the likes of the Hang Seng Tech Index moving 1% to the upside, but broad gains you're seeing here, for instance, the Hang Seng Property Index also moving higher, a 10-cent gaining. You've got the likes of Alibaba as well in the green. Let's change on. It really is that story of Nvidia-linked stocks coming through, and overnight we saw, of course, Nvidia becoming the world's most valuable company, so beating the likes of Microsoft, Apple. We've really seen those three jockeying here, but it's that question, okay, we passed that $3 trillion mark. When does $4 trillion become the key question here? But you are seeing those supplies to Nvidia as well moving higher. Geopolitical questions as well. That is certainly to note, given you've seen, of course, the US moving to further restrict China's access to advanced chip-making equipment, also looking to further restrict companies from using any of China's equipment as well. But that's the state of play here. It could be perhaps behind some of the lags that you're seeing for the likes of Sunny Optical. As well, other movers to note, so you've got the likes of IMAX China, for instance, wander in focus, but we know that IMAX China is planning to expand its presence. At Xiaomi there, you've just seen a block trade of 2 million shares crossing the terminal in the last 20 minutes or so, and continuing to track the moves that we see for JD.com, given we saw the 618 shopping festival wrapping up yesterday, Yvonne, and really drawing some perhaps record sales here, orders as well. So, again, it's that real question, because you saw those inflation numbers coming out last week, and it tells you that consumer pulse is very weak, but still you get the likes of JD.com posting these better than expected figures.
All right. Yeah, before we get to that, we are getting some lines here from the Lujiazui Forum, and we're hearing from the head of the NDRC himself, Mr. Wu Qing. So talking a little bit more about drawing more mid to long-term capital to the capital market. Obviously, this was something that was anticipated, or at least some reports are saying that they might announce some market policies in this Shanghai forum for the next 2 days. Also, we talked about this yesterday, a little more emphasis on that Star 50 gauge, right? So to announce star market reform measures as well. Many analysts were flagging that this could be that next thing to watch here, now that we've seen a bit of consolidation in this equity space, given this push into tech, innovation, the like, and really focusing more on these small caps here right now. I want to bring in our Asia equities reporter, Charlotte Yang. I know we're going to talk about JD, but let's talk about Lujiazui, because we're starting to get some lines through that. Right? You know, what else are we expecting from this forum?
So before I came, I was just chatting with traders, and it seems to me they have a really long wish list. And also there was a lot of chatters yesterday on Chinese social media about, potential extension of trading hours, or just lowering threshold of stock connect. I mean, in a nutshell, to make it easier for investors to access markets. But whether that will come true, we'll have to watch. But I think the top thing everybody's watching is if we will get the announcement of waiving the dividend tax investors have to pay right now, for if they invest in Hong Kong stocks. We had that scoop earlier, and that triggered a positive reaction from market. So I think the session, traders say they're watching, one is the opening remark today, or the end session tomorrow, which they will talk about also financial reforms. If that comes.
And just given what we're hearing around the Star 50, where do you think the trading action goes to here? Because we've been speaking as well that gauge could actually be ripe for a rebound.
Yes, I think if there is enough meaningful catalyst, we could see that, given onshore market has been trading quite muted, I think, sentiment-wise. But I think, but to put it into broader context, the big thing is we'll still be watching, what happens with the third plenum in July. So I think it has to be big enough, to excite investors to actually go back to those, more risky shares.
Yep, some more from Wu Qing here to enhance the support for those innovative firms, that possibly the ones that are listed on the Star 50, and to support related listed firms, reorganizations, as well as mergers. So you're getting a little bit more details of what these reform measures might be for these small caps as well. I want to pivot to a little bit more about what else you're watching, your team today. Obviously, we're wrapped up to 618.
Yes.
How are you looking at JD and the rest?
Yeah, so the e-commerce sector is the key thing to watch today. So while we're still waiting for, because we haven't, the analysts said they haven't heard the official announcement from Baba and PDD yet, but so far from JD, it does look pretty positive. You know, the record GMV sales and also record order numbers. And based on the pretty positive May retail sales data, Citigroup is saying that it could be a pretty positive readout for PDD as Alibaba as well. But companies aside for the Aircon sales, it's looking pretty weak. So some companies related to that could be seeing some actions, and also, but sportswear is also one sector that they flagged that there's pretty resilient demand. So Li-Ning and Taz is also watching that.
All right, Charlotte, thanks very much for those insights there. That was Bloomberg's Asia Equities reporter, Charlotte Yang. And later, of course, in the show, we're going to have more on the Lujiazui Forum in Shanghai. Going to be speaking with the founder, managing director of ZBen Advisors, Peter Alexander. His firm is actually based in Lujiazui, so someone who's perfectly positioned to tell us what he's hearing on the ground. Let's get to some of the other big corporate stories that we're following this morning as well. And Nintendo has announced several new games for the Switch ahead of the expected launch next year of a new console. It's revealed a new Mario role-playing game and a fresh Zelda title that will star the iconic princess. The announcement suggests that most of Nintendo's development teams are focusing on the next Switch. Boeing CEO Dave Calhoun has faced severe criticism at a Senate hearing focused on the aircraft maker's safety record. It was his first public appearance before Congress since taking over at Boeing in early 2020. Senator Richard Blumenthal accused Boeing of focusing on profitability ahead of safety.
You and your board of directors have a duty to your shareholders, but they will be deeply ill-served if you fail to correct course to confront the root cause of this broken safety culture.
And Japan's Norinchukin Bank says it plans to sell around $63 billion in US and European sovereign bonds to staunch the bleeding from wrong-way bets on interest rates. The agricultural lender has confirmed it's now facing a net loss of almost $10 billion, as triple its previous forecast. The bond sales amount to almost 1/6 of the bank's global portfolio. Plenty more ahead. This is Bloomberg.
All right, 9 minutes into the session, this is what we're looking at here right now. The CSI 300 is still looking a little bit weaker than the rest of the pack here today. So offshore, there you go. Hong Kong is up some 1% and getting close to that 18,100 level. HS Tech, certainly the Nvidia stocks that have been tracked here certainly is helping as well. Also, some of these e-commerce stocks in focus after we wrap up 618 as well. Of course, some lines that are crossing in just the last couple of minutes here from Qing from the CSRC, talking about NDRC, I should say, to enhance support for innovative firms and to announce reforms in the STAR market. So certainly that's when we're watching out for any sort of details, right? Charlotte was just talking about. There's a laundry list traders are hoping for, whether it's extending hours or even talking about lower barriers for a lot of these innovation firms to list.
Yeah, and as we've been discussing, Star 50 perhaps looking set for a rebound. But, of course, geopolitics never far from the headlines. And the Premier, Li Qiang, has arrived in Malaysia for a 3-day visit, shining a spotlight on the Anwar government's balancing act between relations with Beijing and also Washington. Let's get more on this with Bloomberg's Avril Hong in Singapore. And Avril, of course, we haven't seen a Chinese Premier visiting a Southeast Asian nation going all the way back to 2015. So just put in context the significance of this visit.
Yeah, I mean, it's coming at the time when both the U.S. and China have been courting these countries in the Southeast Asian nation. And I think this latest move by Li to make a visit to Malaysia is a step in that direction. I mean, China has been making overtures, if we can put it that way, to kind of court these countries, smaller nations that have made quite clear that they are neutral when it comes to U.S.-China tensions. In some ways, though, it's worth noting that this visit is more important for Malaysia than it is for China in a way, because for Malaysia, it's really about enhancing its business interests, boosting its economy. I mean, we've seen the leader really trying to make Malaysia this place, this prime investment destination for both countries. the U.S. and China for companies from both sides. And it has recently announced these tech-related investment pledges from the likes of Google, Microsoft, also ByteDance. And this is despite having, political disagreements with Beijing over the South China Sea, as well as with Washington over the Israel-Hamas conflict. So you can see here the priority is really for business interests, and this comes at a time as well when Malaysia is trying to position itself as this prime investment destination for both sides.
Yep, obviously there's a lot you say on the economic ties. Anything that we can expect from this trip in terms of any sort of trade pacts or anything?
Yeah, we are expecting a renewal of a 5-year trade and economic pact, and this would be for industries such as robotics. We also heard a day ago from Anwar Ibrahim saying that Malaysia plans to join the BRICS economic bloc. We are also watching very closely Lee because he is expected to be at the groundbreaking ceremony of the East Coast Rail Link. And this is significant because it's a project costs about $11 billion, but it's a part of the China Belt and Road Initiative. And it's interesting because this is also a project that has seen in past Malaysian administration stops and starts. It was suspended, it was resumed later after renegotiations, and the cost was significantly brought down. So Lee being at this groundbreaking ceremony, I think, is also something that's seen as quite significant.
That was Bloomberg's Avril Hong there. And of course, it's not just China's premier who's visiting Malaysia. Russia's President Vladimir Putin has arrived for his first visit to North Korea in 24 years. That's after praising Kim Jong-un's regime for its support of his war in Ukraine. Let's get the details from Bloomberg's Korea economy and government reporter Soo Hyung Choi in Seoul. And as we said, we haven't seen Putin visiting North Korea for more than 2 decades. So why now?
Kim Jong-un invited Putin to visit North Korea when they last met in Russia in September. So this was supposed to be a 2-day visit, but it looks like it could be shortened as Putin arrived in Pyongyang at 3 in the morning. Putin is widely expected to seek more munitions for his war in Ukraine. South Korea's assessment is that North Korea has already shipped some millions of artillery shells and dozens of ballistic missiles to Russia. We might see new types of weapons being handed over, as well as Kim Jong-un has been increasingly spotted at munitions factories and weapons tests, but we'll have to see what it comes.
So, it's interesting that he's there. What do you think Kim Jong gets in return? I mean, what are they expected to actually agree on?
Kim Jong-un would need a lot of things from oil to cash, but I guess at the top of the list would be any support related to its space program. We just saw North Korea's last satellite launch end in failure in May, and that was despite Putin's pledge for space cooperation. So we might see more support on that end. But analysts say even if the two sides agree on the transfer of any sensitive military technologies, it's very likely it will not be disclosed to the public. Also, the focus is on the level of their economic and military cooperation, as the two leaders are expected to sign a new treaty on strategic partnership.
China has for a long time really been the main benefactor of North Korea. Are we seeing some sort of realignment now between North Korea and Russia? And then off the back of that, how do you see the likes of the US and South Korea reacting as well?
U.S. Secretary of State Blinken has described this Putin's visit as a desperate attempt to get what he needs to win this war in Ukraine. South Korea said it has warned Russia not to cross the red line. And South Korea's Defense Minister Shin Won-sik recently told Bloomberg News that he considers any transfer of sensitive technology related to North Korea's nuclear and missile programs to be a red line for Seoul. It's a bit complicated for Beijing, as you said, as Beijing has been the economic lifeline for Pyongyang for years, and it may not want to share that influence with Moscow. China's vice foreign minister just had talks with his South Korean counterparts in Seoul yesterday, hours before Putin's arrival, and said he hoped Putin's visit would contribute to peace in the region.
Su-Hyung, thank you. Su-Hyung Choi there joining us, our Korea economy and government reporter in Seoul. Some other geopolitical stories that we're following from around the world. China is warning a bipartisan group of U.S. lawmakers not to meet with the Dalai Lama this week. Beijing has voiced strong concerns over the trip as the delegation arrived in the Indian town of Dharamshala. Now, the group, including former House Speaker Nancy Pelosi, is set to hold talks with the Tibetan government in exile and meet with the Dalai Lama later on Wednesday. Israeli Prime Minister Benjamin Netanyahu is accusing the U.S. of withholding weapons for the war against Hamas. In a video statement, Netanyahu says he appreciates Washington's support, but finds it inconceivable that arms have been held back in the past months. While the U.S. has paused one shipment of large bombs, the White House denies any other weapons are being withheld. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. And Citigroup is putting its services business in the spotlight as a key component of the lender's restructuring and profitability plans. In an exclusive interview with Bloomberg, CFO Mark Mason lays out the bank's plan.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, all right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business and our security services business.
It's interesting because, to your point, even though security services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup's stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today, you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup's stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%. And we talked about the services businesses being a significant contributor to that, both in the top line and our services business is a 20% return on tangible common equity. In the wealth space, we brought in new management there. And we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure to increasing the banker productivity to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
That was the Citigroup CFO, Mark Mason. They're speaking exclusively with our colleague, Shonali Basak. Just some breaking news crossing here when it comes to Norinchukin Bank. This is, of course, Japan's biggest agricultural bank. So they are going to be diversifying their investment portfolio after selling roughly 10 trillion yen. That's about $63 billion in U.S. and European sovereign bonds. So they're disposing these foreign bonds gradually. And then in terms of options investment, collateralized loan obligations is one thing that they're considering. Also looking to investing in domestic and overseas bonds, stocks, and project financing. So this is after, of course, they reported that net loss of about 1.5 trillion yen for the current fiscal year, which is triple the previous estimates of 500 billion yen. So certainly they're doing a little bit more in terms of changing up their investment strategy moving forward here right now. It brings us to a discussion here on what's going on in China. Obviously, we're focusing a lot on what's going on in Shanghai in the Lujiazui conference forum, I should say. We're hearing hearing a little bit more from the CSRC about maybe some more market reforms coming through.
Yeah, well, it's that really big focus on what's sort of announced, particularly around the Star 50, and is there going to be even greater support coming through for innovative firms? And that is certainly, of course, something that China has been really focused on, and you've seen that push from Xi Jinping right from the very top to foster China's homegrown tech industry, of course, with those rising geopolitical tensions between the US and China. But just some of the headlines that are coming out of this, they're going to enhance support, as we said, for innovative firms. There's going to be reform measures coming through for the Star 50. So certainly we want to get more details. Is that going to be enough to impress investors?
Yeah, I mean, he's done a lot since he's taken office, right? Just everything from cracking down on quant trading. He's been talking about scrutiny of listing of firms. And so certainly this is just more to his plate. We'll see if that's enough to really kind of reinvigorate this market here once again. You take a look at how markets are doing here right now. It is continuing on. We'll see some tailwinds here, although onshore markets are still not doing as well. We're down about a third of 1% in the CSI 300. Hang Seng, though, I think we're around those session highs now, up close to 2% gains there. HS Tech is on bid, and we are still seeing a little bit of a rally in CGBs. So a little bit of both. Still seeing gains in stocks and bonds today.
Yeah, really two different stories that's going on, I'd say, because you've got, on the one hand, you've got Nvidia and all the gains that we're seeing in tech, and that's really what's leading that for the Hang Seng there. You can see the Hang Seng Tech up 1.3%. On the flip side, what seems to be really dragging down the Shanghai Composite so far is what we're seeing in consumer discretionary. You've got the likes of Kweichow Moutai, again, sliding for another session. You've got the likes of some of the big electronics makers like Midea as well. They didn't perhaps see really good sales in the 618 festival, even though JD.com as well said that they actually had record numbers. So it's really just a few different stories, but of course, a lot more to discuss in the hour ahead.
I think, consumer trends are shifting, right? I think Charlotte had mentioned that the air conditioning demand was low, maybe because of what we've been seeing in the property market and the like. Coming up the next hour, we're going to talk markets with Pepperstone Group, Chris Weston, and the key risks that they're seeing. Plus, we hear from Zeben advisors in Shanghai as the Lujiazui Forum gets underway.
Welcome back to the China Show. Taking a look at mainland markets, Hong Kong as well, just getting underway this morning. A lot of focus on the Lujiazui Forum that's kicking off in Shanghai. Are we going to be getting any sort of market reforms that can be enough to impress investors? So far, we've heard from the CSRC head, Wu, indicating there's going to be further market reforms. Now the PBOC governor, Pan, has his turn to share any sort of views. Right now, he's saying actually Chinese monetary policy is supportive. Of course, we have seen a lot of investors really testing perhaps the resolve of the PBOC government, but there as well, Pan saying that monetary policy is going to be offering financial support or some sort of support for the economic recovery. So as well, we have seen some weaker signals coming out, particularly around consumption in China. But the movers so far, well, the Hang Seng really being dominated so far by the tech space, and in particular, you've got the likes of BYD, for instance, Tencent, NetEase, JD.com. These are all leading the gains so far, Yvonne.
Yeah, it's really tech that's driving things, but it's interesting what you're hearing from the PBOC governor, that things are looking supportive. This doesn't seem like this is a central bank that is in a rush to cut rates, which is what we saw this week with that MLF as well. The LPR is tomorrow, mind you, as well. We'll see if we see anything from the banks, but certainly it seems like the market still expects, at least from the guests that we talked to, that there is still room for those rates to head lower, I should say, and that's why the CGB rally continues relentless at this point here, despite those warnings from policymakers. In terms of what we're watching in some of these big names as well, Kweichow Moutai, it's another day. I think we're down for a fifth session for Kweichow. Jeffrey's coming out with an interesting note saying it may have to wait until July for the company to actually start supporting wholesale prices. We're also watching a little bit of some of these home appliance stocks as well. So 618 is wrapped up, and it looks like, according to an analyst, that it seems like some of these white goods didn't do quite well during that festival. So everything from air conditioners, which had seen low demand. So that's why you're seeing Midea Group, Gree Electric. Those are slightly lower here as well. Xiaomi could be also impacted, but that stock's actually doing quite well. And JD overall, they're still talking about record orders, record GMV. I think it was like 500 million people that took part. So some pretty good numbers when it comes to JD. Still waiting for the likes of Alibaba and the others to report their numbers as well. Asia ex-China is doing this here right now, so it's still looking pretty good, given, of course, Nvidia became the world's largest company overnight. And so that's certainly lifting a lot of the tech-heavy sectors here today. So the Nikkei, the Kospi, TAIEX, look at that. You take a look at Taipei, we're up 1%. That's really been lifted by these chip stocks here this morning. What else are you watching?
Well, actually, I think to note, I read this morning that that Nvidia is now worth 2 times the Kospi. That just puts it in perspective.
I mean, it gained $2 trillion in market cap just this year alone, which is basically the size of Amazon and Meta.
It's wild numbers, and it's really hard, I think, to comprehend, but it just tells you how much AI is still the main focus for investors here. I think there's, of course, a lot of different questions. How much further upside is there? Nvidia would really make the point that they're not just a chip company, and they're not just about the GPUs. They're a full-stack solutions provider. So there's software, networking, all of those. Are they really fully appreciated yet? But at the same time, you've seen so much demand for AI chips as well, but yet we're really yet to see that translate to profitability. What sort of impact is that having for companies' bottom lines? And is it perhaps a little bit overdone, the demand? Are we going to see it perhaps taper off a little bit? Of course, a big question. It seems hard to appreciate that right now, but it's just something I'm hearing from people that I'm speaking to.
Yeah, I think they're saying GPU chips are basically the new gold and oil. That's what Webush's Dan Ives is basically calling it. So maybe there is still more upside for this stock. I think Rosenblatt was the latest one. Securities there saying that $200 is their new price target for that stock. Wall Street high for that one. And it brings us to this Bank of America Global Fund Manager survey, which basically talked about one of the biggest, most crowded trades. Yeah, large cap tech, if you can believe it. They took a look when it comes to sentiment. It's the most bullish that they've seen since November of 21. Cash levels have been the lowest in 3 years. And it's interesting as well when they talk about cash levels and the amount of money market funds and, you know, how much of those cash, you know, is going to be redeployed or reallocated to other asset classes. I mean, that's debatable, but most people are thinking it's going to be U.S. stocks, it's going to be stocks in general, and then maybe it's going to be on bonds as well.
Yeah, so even though the trade is looking very crowded, it seems like investors still want to get in. So let's get more on that now, bringing Chris Weston. He's head of research at Pepperstone Group. And Chris, as we've been discussing here, yeah, Nvidia, now the world's most valuable company, but you've got that new research out from Bank of America saying that investors still like these growth stocks. Would you be putting money into the Mag 7 at this point in time?
I certainly wouldn't be betting against them in any capacity at all. I mean, I think, you know, there's real upside further, you know, in Nvidia. Every pullback is being supported. You know, you go into the options markets, every day we're seeing significant levels of call activity relative to puts. So the gamma squeeze continues to be on, and dealers are hedging you know, their exposures by buying the underlying, and that just perpetuates the move higher. You know, so just the sheer, you know, degree of the pullbacks, you know, being very small gives me the belief that there's the path of least resistance remains higher into Nvidia's earnings, which don't come out until sort of, I think, 23rd of August is when they're scheduled. And maybe then there's going to be a point that's going to be the point where the gross margin story comes into fact, because it's going to probably pull back to about 75%, and we're going to plateau going forward. So that the sort of halcyon days of 78%, the realism is now that we're going to get back to more to levels around 75% where it plateaus. Maybe that's the level that some of this heat comes out. Yeah, maybe valuation does actually matter. It's trading on 50 times now. I really wouldn't want to be seeing it much higher than 55, 60 times. So, yeah, squeezing and a decent squeeze higher, I think, would offer opportunities to lay off. But for now, this is a momentum beast. Momentum is killing it at the moment, and I think that continues to be the trade.
And I know you write a lot about U.S. exceptionalism, Chris. Do you think that 2024 we're going to end the year with the U.S., the S&P still hitting record highs and this dollar continuing to gain?
Well, I think the dollar's a different story at the moment. If you look at the dollar index, obviously the euro is a big interesting situation because it has broken away from the rate story. You know, you look at one-year rates relative, and euro dollar's just broken away from that since the beginning of the month. Obviously, French political risk premium is the driver at the moment there. But the equity story, look, I mean, I think, you know, look, everything's yeah, the index looks very rosy indeed. You've got the Nasdaq pushing 20,000. Optionality looks good. People are selling vol. Yeah, obviously, very, very crowded. You talked about the Bank of America Merrill Lynch survey at the moment, but you go and have a look at risk control funds at the moment. 15%, 18% risk control funds. These guys are fully invested in the market. So I think that's positioning is very crowded, but it's these 5 stocks that are just holding things in. So when you look at it below the surface, things look very, very different. Only 30% of stocks in the S&P are actually outperforming the benchmark. Market internals are not great, but that's been a very poor predictor of returns in the index level, which are driven by these momentum beasts at the moment. And I could continue to think that at an index level, they go higher. The Nasdaq goes through 20,000. I'm selling volatility on spikes, but below the surface, there's two-way opportunity at a single stock level for sure.
Yeah, and give us more details on what opportunities you're seeing, because as you said, that market breadth is poor. So are there any sectors or names that you think are looking particularly unloved?
Well, I'd be looking at the banks. The KRE sort of come off our radar a little bit recently, but the KRE is just pushing this big it's very, very well nicely defined support level around $46. And of course, as we come into earnings season, with JPMorgan kicking things off on the 12th of July, we are going to be looking at, exposures, the consumer. Obviously, we saw the retail sales number last night, which I think the Fed will be very pleased with what they saw there. But we're going to be looking at some of these consumer metrics, and obviously that's going to feed into the banks with the higher for longer thematic there. So I'd be interested in the banks. If we saw a breakdown below $46 in the KRE, I'd be looking at shorting opportunities. But again, I think when we're looking at it as an opportunity at the moment, I like long short strategies. I think I continue to like long Nasdaq in this strong momentum market, and offsetting that against the Russell or the IWM. I think is another way to play that. I know everyone's saying that there's so much refinancing risk being built into the small caps at the moment because of the higher for longer trade that it's probably due a bounce, but I don't see that at the moment. And the way I'd actually be playing that, any bounce in that pair, then I'd be looking at re-establishing new positions there. So I like the long Nasdaq, short Russell trade. I still think there's some juice in that one as well.
Chris, I'm curious that when you talk about banks, if you can discuss Citigroup at all, because we've seen them putting their services business, for instance, back in the spotlight. Do you have any views on that? And do you see further upside in that name in particular?
I don't cover the individual stock banks. I sort of look at them more of a sort of a macro thematic and how they're sort of playing in. But I wouldn't be able to comment on the individuals that individual name.
Yeah, just moving on. I just want to talk a little more about. Yes, so I see the case for this equity rally in the U.S. to continue, right? You have the macro data, you have the earnings, profit growth and the like, Chris. I'm just wondering when it comes to another factor that people are talking about, which is this massive stockpile that we're seeing in terms of money market funds and cash, that, eventually that we're going to see that reallocated to other asset classes like stocks or even bonds here right now. How much cash do you really think is in the sidelines right now? Are we really likely going to see a lot of this dry powder being deployed to riskier parts of the market?
Well, I think it's. I think the better one for me right now is what's happening in that Bank of America survey, where cash managers levels are around 2.1%, I believe the number was, but at very, very low levels. I think that's a probably more realistic situation about cash on the sidelines. The money market funds, I don't think there's a direct link between what happens in money market funds and going into the equity market. I think most of that funds would go into the bill market, into the treasury market. So I think that's where the direct link comes in, rather than going directly into the equity market. But of course, people have been talking about that ballooning pile of money market funds for quite some time. But equity markets go higher. That pile of cash and money market funds continues to go higher, and maybe that changes, through as QT develops. But for me, I don't think there's a direct link necessarily between money market funds. And I'd be looking more at the Bank of America Merrill Lynch survey, but also, on Bloomberg, sure, you can look at the risk parity funds. These guys are obviously very prevalent in the market as well, and they're max investors as well. So from a positioning perspective, I'd look at that more closely.
Chris, how closely are you watching, or I'm sure you are watching it quite closely, but how are you managing the risk with France's snap election? You mentioned the bearing perhaps it could end up having on the dollar, but are you seeing any sort of ripple effects, and are you investing in Europe at all right now?
No. No, I think there will be an opportunity, a very good opportunity in France, but in markets, the 30th of June is a long way away. And the 7th of July is an even longer way away. So we're still watching the polls as they come out. But I think as they stand at the moment, the RN party under Le Pen is looking for about 235 to 265 seats, short of the outright majority of 289 seats that they need in that first round. So it feels like a base case at the moment, and how we price risk around this is that we will probably see a Le Pen victory based on the polls, but it's unlikely that we're going to see an outright majority. The good situation for me here is I know we've just seen France being put on the excess deficit procedure monitor, which we're all sort of struggling through ChatGPT to understand exactly what's going to happen now. But ultimately, the way I see this tactically is that Le Pen has a presidential election to win in 2027. She is not going to go and smash the budget, run the risk of losing the credibility from the bond market. She needs the bond market on side to win that 2027 election, because France have a huge amount of debt that they need to refinance, and she needs to do it at good levels along with her Prime Minister, Jordan, there. So I think she needs to win that, and I think that any idea that she's going to be fiscally reckless is probably wrong. Tomorrow is going to be interesting because France are going to be issuing about 10 billion euros of medium-term debt. We'll see the appetite there for the market. If we see weak demand, you could see sovereign spreads widen, the euro come under pressure. But I think in the short term, given how much risk, how much time there is, to the second round, I think there's still a lot of volatility in French assets.
Okay, so staying away for now. What about for China? I mean, is there still much appetite right now after this rally? We've seen a couple of weeks of just a lull in these markets, looking for the next leg up. What are we still missing right now, Chris?
Great traders market, the Hang Seng. We are seeing a bit of a bounce now, and I think momentum again is the play for Hong Kong. So we're looking at the rate of change if that starts building up. I like it when you see in Chinese markets, you see a bit of FOMO kick in. We're nowhere near that point at the moment. But I wouldn't be surprised if we saw a little bit more juice to the upside. We want Tencent, Baidu and those names to participate in this move higher. But you can't trust the rallies we're seeing in these markets at all. Really, I think probably one of the defining points to have that conviction is really the bond market. We know that they're getting away a lot of these special bonds with very, very good demand, but the 10-year cannot sustain any bounces in yield. And in fact, we're probably more likely to retest those, the lows we got in April and the 10-year around 222. So I think that's your defining point, that the mechanisms they put in place, the PBOC and the government, to drive consumption leads to a more definitive reflation environment. You've got to be watching the bond market. So, until we see yields, trending higher, I think you can't have huge conviction in China at the moment.
Chris, thank you. Chris Weston there, head of research at Pepperstone Group. Just talking about China here, we're getting some more lines crossing from the Lujiazui forum in Shanghai from the PBOC governor, Peng Gongsheng. So to keep maintaining supportive monetary policy, to strengthen counter and cross-cyclical policy adjustment, but to avoid major swings in policies. The latest line is interesting, to clarify the main policy interest rates in its next step. So this is certainly what the market has certainly been waiting for as well, and what the next step for the PBOC is going to be. Are they leaning towards more rate reductions in the near term, or even in the second half of the year? Certainly is the big question here. And also they're talking a little bit more about credit growth. That it's hard to keep credit growth at about 10%. We obviously have seen still weak demand when it comes to the credit side of things, but they will try to improve some of the statistical scopes when it comes to N1 money supply, for example, here as well. So still talking a little bit more about that. Major economies policy shift helps expand China's policy room. So yes, obviously they are watching what's going on in other central banks as well.
As you said, looking a little bit bigger picture as well at the dollar trend, because they're saying that weakening appreciation we've seen has been something that's been beneficial to the Chinese currency as well. But of course, we're going to have a lot more ahead from the Lujiazui forum in Shanghai with the founder and managing director of ZBen Advisors. That's Peter Alexander. This is Bloomberg.
All right, chip stocks very much in focus here today. Obviously, the Nvidia story is what's helping the likes of Taiwan Semi, also Samsung Electronics here today. But also, there's been this Bloomberg scoop saying that the U.S. is stepping up pressure for Japan and the Netherlands to restrict China's access to key technologies.
Yeah, and not just that, focus on restricting the likes of Japan and the Netherlands, but there's also a new bill in Washington that's seeking to bar companies like Intel, Taiwan's TSMC, from buying Chinese gear. So let's get more on this now with Masahiro Wakatsugi. He's the Asia-Pacific Technology Analyst at Bloomberg Intelligence. And it seems that the U.S. at this point in time, Masahiro, thinks that the current measures aren't working. Why is that, do you think? Just how much further is China advancing in its quest to make the most technically proficient chips?
Yes, regarding maybe the restriction, so far probably U.S. may be surprised to see China succeeded in developing the maybe 7-nanometer chips. And the restriction was aimed at, to prohibit China from making 7-nanometer chips. But when it comes to 7-nanometer chips, we can make that chip based on the existing equipment or technology. But for example, TSMC is now making 40 or even 50% of operating margin. And when they make the 7-nanometer chips based on the new extreme ultraviolet tools, we call it the EUV tools, they can achieve a very high operating margin. But if they have to use the older generation deep ultraviolet tools, this we call it the DUV tools, maybe the operating margin could be lower. But if we look at the Chinese chip makers, maybe they can have some subsidies, or maybe it's China's national project, so they may not have to worry so about the profitability or production yield. In that sense, any company can make the 7-nanometer chips, or even 5-nanometer chips can be made based on the existing, a bit older technology or older equipment. So that's how China is making progress.
And maybe that's why the U.S. is reaching out to its allies. I mean, what are some of the possible measures that we could still hear from the U.S., the Netherlands, and Japan?
Yes, there may be two ways to restrict further going forward. One is that maybe the restriction may be aimed at a specific maybe Chinese customer, Chinese chip maker. And in that sense, if we look at the overall capex for the global semiconductor, China represents about maybe 30 or 35% of total capex. And if we look at each one China chip customer, chip company, the capex represents about 3 to 5%, even 7% of total global capex. In that sense, the damage could be quite maybe manageable, and the damage could be shared by the evenly by the all suppliers. In that sense, the restriction could be aimed at a specific China chip maker. But the issue is that in China, we see quite many companies emerging one after another. So it's a bit tough to restrict all this kind of new companies. And if we try to restrict a specific tool, for example, lithography tools, in that case, the damage could be concentrated on the specific suppliers, including ASML or maybe Nikon in Japan. So in that sense, it may be a bit tougher to restrict on the specific equipment, I guess.
As you say, Masahiro, we're continuing to see more Chinese tech companies come out in this industry in spite of the restrictions that are in place. So is it even possible to stop the development by China?
Yes, so probably it's it's not easy to completely stop the technology development. It's always happening. The technology development is always happening. So when we look at the chip development, probably maybe U.S. could delay the speed of the development. For example, like 5 nanometer chips or 3 nanometer chips, because these chips could be only made by EUV tools. Theoretically they can make, but it's really difficult. But now I think that the U.S. government may be aiming at all, not only chips but also equipment as well. And if when we look at the lithography tools in China, maybe they can make probably 28 nanometer chip-related tools, but China may not be able to make the lithography tools to make 14 nanometer chips and beyond. In that sense, maybe more effective to impose some sanctions on the equipment side going forward.
That was Masahiro Wakasugi there, Asia-Pacific technology analyst at Bloomberg Intelligence, and we'll have plenty more ahead. This is Bloomberg. All right, we're just under 1 hour into the session so far, and just taking a look at what we're seeing, it really is a very divergent theme coming across. You've got the likes of the Hang Seng Tech, Nvidia, linked names really pushing higher here, and then the likes of the CSI 300 a little bit under pressure so far, given we're seeing a little bit of weakness coming through in the likes of appliance sales so far.
11:29 a.m. in Tokyo. Japanese markets are going to lunch break here, and they are continuing to like this market here today in terms of what traders are looking at. And this equity market, we're seeing upside about 0.6%. The Topix is doing a little bit better there. And that yen, I guess you could say, has some strength, but we're still talking about 157 levels as well, Bill.
Yeah, and some, of course, have been saying 160 could still be possible for the Japanese currency. But let's take a bit of a broader look now. Asian markets, of course, getting underway this morning. And so far you are seeing positivity really across the screen here. Those gains very much being led by the IT index. You can see they're up 1.7%, but most of the sectors are in the green so far this morning, with the exception there of consumer staples that you can see. Dollar fairly flat at this point of time. Treasuries, of course, not trading because we're approaching, or we're into the Juneteenth holiday trading period right now in the US. But again, it's that real story of Nvidia, and overnight we saw it becoming the world's most valuable company. And so that is, again, as we said, underpinning a lot of the optimism so far today, the moves around to AI and growth stocks in particular. One name that we're tracking in China is Bilibili, of course. That stock is surging more than 10% in the session so far. It does seem perhaps it could be linked to a call that came through from JPMorgan. They've actually raised 8 shares to overweight. Their price target is now 165 Hong Kong dollars a piece.
Yeah, so that's about 36 or 30% increase from current levels here right now. But yeah, they're talking about significant upside to earnings forecast. The recent Three Kingdoms theme strategy mobile game has become a blockbuster, and the firm is confident in the longevity considering the track record of peer games. That's according to JPMorgan as well. Of course, another big story that's happening in China today is the Lujiazui Forum in Shanghai, and this is what we're hearing just so far. We've heard from the PBOC governor as well as the CSRC head Qing. From Pan Gongshan specifically, talk about bond buying, selling, not QE. So once again, still pushing back a lot of commentary out there that maybe China might be considering this or needs some sort of quantitative easing here right now. The interest rate corridor to be narrow. They're considering maybe the short-term PBOC operation as the rate target as well, and still saying that monetary policy remains supportive so far. You take a look at what we heard from Qing in terms of market reforms. We're getting a little bit more detail. They want to support listed firms' reorganizations, their mergers. They're enhancing the monitoring of high-frequency trading, and it really enhances support for these innovative firms. And the star market is what they're targeting in terms of where the next reforms could be coming in to draw, of course, that mid to long-term capital to the market as well. But I think people are still looking for a little bit more specifics on what that star market reform is going to be, whether it's going to be lowering the thresholds, whether it's, I don't know, changing a little bit more of the barriers, really.
Yeah, exactly. You want to see perhaps a greater access and greater inclusion in this index. But let's get more now from Shanghai directly. Peter Alexander is the founding and managing director at consulting firm ZBen Advisors. And Peter, what do you make of what we're getting so far from the event?
I would just say it's more than what would be expected. We're at least seeing some commentary coming out of the regulators. We're talking, 4 months since there was the market meltdown, the introduction of a new chairman to the CSRC. It's going to take a bit of time before real details will come out. So the fact that there are any details at this point, I think that's pretty positive.
Can you tell us, you're based in Shanghai, you're in the Lujiazui area. Peter, can you tell us a bit more about what it's like, sentiment on the ground here from the clients and the businesses that you talk to? Is business really coming back to the mainland?
In terms of the foreign community, the short answer is no. There's been, number one, I would say the sentiment locally, which has been, clearly impacted by the ongoing softness in the housing market. It's much better than it was 6 months ago. But there has been a consistent, I would say, drumbeat of geopolitical stress that has permeated the entire global community in terms of businesses, that China is just not a place you want to go, not a place that you want to invest in. And you can see this from the level of, or the decreased level of senior executives that are traveling. And the Lujiazui Forum is a good example. We just this morning got the list of individuals that'll be participating, and there was a very limited number of global executives that'll be attending. And I think that's just indicative of the current state.
And perhaps the future state as well, Peter. Do you see that reversing at any point in time? And what is the impact then? Are we going to continue to see weakness in FDI?
Yeah, there needs to be, at least in my opinion, a sentiment shift globally. And I suspect that we will see this. Look, I've been in China for 30 years. For me, this is the fourth cycle, if you will. Whether it was Asian financial crisis, SARS, the global financial crisis, there are ebbs and flows. I view this as just being one of those cycles. The primary difference, though, between those periods and today, again, are headline risks. We're aware of clients, quite frankly, that have a no China travel policy. And look, I'm all for risk management. I believe that's a great element for all organizations. But this is borderline, I would say, hysteria. It will trend downwards. It's just a matter of when, perhaps later this year or sometime in 2025.
And I guess maybe not just the housing market. I'm guessing we need this Chinese stock market to actually stabilize, or at least get back to on some sort of positive trend. I'm wondering what you're hearing from, obviously, the CSRC and Qing. He's come to this job quite aggressively, I believe. Everything from cracking down from quant trading, scrutiny over the listing of firms on their benchmarks and the like. I'm just wondering, what other capital market reforms, can he do or should he do to really turn around this market?
Well, I think there are two that are front and center at the moment, and quite frankly, not really being covered. There is the speculated, although I think it's more than speculation, of a merger between Haitong Securities and Guotai Junan Securities. And if there's one thing that China needs to do, at least from my perspective, is a reduction in overall capacity among the securities broker-dealers throughout. I think there's something still like over nearly 100. And if they were to move forward with such a significant merger between these two very large brokers here in Shanghai, you'd probably see this continue into Shenzhen and Beijing with some of the larger brokers there. The second, I think, focus that we're very closely monitoring is the development of the ETF market, quite oddly. And, one of the issues that China has had to really address is the sheer level of retail participation and the whipsawing that can cause in share prices and indice levels, over the last 15 years. Introducing a more structured, institutionally led ETF business, I think, is pretty high up on the CSRC's priority list.
Peter, as well, we're getting some headlines that are dropping from the PBOC governor, Pan, as well, just talking about what we're getting for sovereign bond sales, and they're looking at ways that they can possibly optimize it. But broadly speaking, you've seen investors that really can't get enough of Chinese bonds and agitating for some sort of policy changes. Do you see that coming, and do you see any sort of changes on the fiscal front as well?
Oh, that's a great question, because I have been very strong when talking with others that it needs to be recognized that Keynes is dead in China. And what I mean by that is, what has it been, the past year or so, where you'll have people on that are always talking about the need for China to have this bazooka of fiscal stimulus. You know, China did that in 2008 and 2009, and it led to some pretty disastrous long-term effects. They don't want to do that again. And while, you know, I'll have people push back and say, well, what about this trillion renminbi special purpose bond? Yes, that was issued and announced back in March, but it was more about trying to put a floor under sentiment, because what have we seen since then is this trickling out of, you know, 30, 40, 50 billion per week of issuance that's going to take 6 months. China simply does not want to blow out its fiscal balance sheet like we have seen in places such as the United States or in Japan. They're trying, I think, to learn those lessons. And it's not like demand is an issue. You know, we've seen actually PBOC coming out just this past week trying to temper the enthusiasm by local investors that are clamoring for yield because there's no other option. Cash is pretty low. Equities are volatile, and housing continues to be weak. So I suspect that this is going to be a fronted war that the PBOC will continue to be fighting for the next several months.
So if the economists are overestimating the amount of fiscal stimulus, I mean, what is still needed on the stimulus front to really, you know, help reflate this economy once again? I mean, everyone's banking on fiscal. If it's not that, what else could it be?
It's a great question, because, you know, the typical answer is going to be, you know, driving consumer sentiment higher, getting more people to be able to spend, which is clearly a struggle. There's also issues such as restructuring the economy, which we're seeing sort of play out, and we'll see what comes out, let's say, in the third plenum next month. But the only thing I can state with relative certainty is that going back to the typical Keynesian playbook of just firing money at the problem, the Chinese are very, very astute and are aware that, you know, it's a sugar high, but it's not going to solve any problems. And especially things like direct consumer stimulus. You know, I've always found that laughable, because what are the Chinese going to do with it? They're just going to park it in the bank. They're not going to spend it. So this is where the structural element of reforms is really required. And it's more about that third plenum and what may or may not come out that will address it. But Yvonne, right now, it's really up in the air, with the exception of knowing that Keynes is in fact dead in China.
All right, Peter, it's great to have you on and get your perspective on the ground there. Peter Alexander, founder and managing director at consulting firm Zeben Advisors. Just want to recap these lines that are coming through from the PBOC as well as the MOF. So the big news is that they are both going to be studying the implementation of government bond trading. So this is quite interesting, right? So they're at least considering something like this. It's going to be a gradual process, according to the PBOC governor. But certainly when they talk about buying and selling of bonds, they did try to reiterate, it's not QE, though, Bill. It's not.
But looking at ways that they can perhaps optimize the sales pace, the structure of the tenors as well. And we just have been seeing, as we were just discussing there, a lot of agitation from traders that there needs to be some sort of policy shift. And as you said, and we just heard there from Peter Alexander, when you've got no sort of yield coming through in equities, the housing market is in the doldrums, where can you actually get some sort of alpha from in this market? And Chinese bonds is really front and center at this point in time.
Yep, something that they've long rejected, this whole even just the phrase of QE, right? So that's certainly one thing that we're to watch out for here today. Mixed picture across, the yield curve here this morning, but you are still seeing the long end still at some of the multi-decade lows when it comes to yields here. This is Bloomberg. Here's your China brief. A look at what's making headlines in national media today. With the top story in the Communist Party's official mouthpiece, the People's Daily, and other state-run agencies, is President Xi issuing a directive to boost flood control and drought relief. Now, that's after heavy rains hit the southern provinces of Fujian and Guangdong. The report says that Xi is calling for, quote, all-out efforts, including rescuing trapped residents and finding those missing. He's also urging all regions to strengthen flood prevention and emergency response measures.
Yeah, and looking at the financial papers now, and the Securities Daily is dedicating a section to the 618 shopping festival and the role of e-commerce platforms in stimulating consumer demand. The paper cites data from various platforms showing sales and orders surpassing last year's. It also says businesses saw sales double compared to the same period in 2023. And this is a story, of course, we've been tracking very well this morning. There's growing concerns in China over the rally in bonds, and funds are now warning of volatility risks. The Shanghai Securities News says fund managers are concerned about policy headwinds and market overcrowding. The report says bond funds have delivered annualized returns of as much as 10% so far this year, and watching the trading action so far, and as you said, it's looking a little bit mixed so far in the China government bond space, but still you're just tracking that longer end of the curve here. Given you broke below that 2.5% mark, we haven't seen it really at those levels going back to April of this year, but a lot of concern or demand for China's bonds in this space, but concerns around perhaps the implications for that for investors if the policy changes shift.
Yep, and you're seeing that breaking news line that just crossed a couple of minutes ago with the PBOC and the Ministry of Finance really studying to implement government bond trading. It's going to be a gradual process that we're hearing so far. Let's get to our China correspondent, Min Lo, on some of these lines that are crossing here from the Lujiazui Forum. How significant is this?
Yeah, it's quite significant because the PBOC, they really have not really stepped into the secondary bond market for, I think, 17 years now. So this really adds to their monetary toolbox. I mean, there's been talk for some time that they don't really need to use bond trading to inject liquidity into the market because the MLF is at 2.5%, so still plenty of room for cuts. But then also the PBOC has shown that they're not very willing to cut rates at a time when there's huge pressure on, depreciation of the yuan. So then bond trading could then help to inject liquidity that's needed in the market to really boost growth here.
And as we've been discussing, that 30-year yield in particular, you're sort of looking perhaps, I mean, it's a ways off, but still you're approaching the level that Japan's is at. So how much lower can you go for yields now?
Yeah, I mean, if you look at the futures for the 10-year note, that opened at above 104 today. That's really the highest we've seen going back to 2015. The yields as well at a 2-decade low, and some analysts are predicting that it can go even further down to maybe 2.18% towards the end of this year, down from the current 2.25%. And it really shows this lack of confidence from investors about the macroeconomic outlook amid those mixed data that we've seen. Big disappointment, especially on Monday, on those housing prices that continue to extend declines despite government efforts to boost the sector. So you have speculative trading from retail investors and companies that are looking for yields higher than their regular deposit rates. And traders also betting on more stimulus to weigh on yields. But of course, again, the PBOC has been defying market calls to cut rates amid those fears of depreciation.
All right, Min, thank you. Our China correspondent Min Lo there on the latest from the Lujiazui, as well as the CGB rally that continues on here. And this really comes amid the rise of India's bond market, which many investors now see as an alternative to the likes of Russia and China. That is the subject of our big take today, with the inclusion of Indian sovereign debt into JPMorgan's emerging market bond index, leading to a $40 billion rush into the market. Let's get more now with our senior FX and rates reporter, Subhadip Sarkar, is joining us from Mumbai. Subhadip, obviously we've seen foreign investors get a little bit more interested in this market in a big way in some ways. What's sort of the case, the medium and long-term case for Indian bonds now?
Well, good morning. The fact that India is now on the global bond high table is kind of a culmination of nearly a decade-long process. So we go live on the JPMorgan bond index on June 28th, that's next week, and India will enjoy a 10% weightage on the index with a gradual tick up by 1% every month. That would be, at 10%, it will enjoy a weight equal to China. Indian bonds will offer a further diversification to investors with China, with China's economic problems, as well as Russia becoming relatively uninvestable. So from being just another global high yield emerging market play, Indian bonds will now be tracked by a large base of passive investors also. The JPMorgan index roughly would be currently be tracked by around $216 billion of assets. So even the passive investors, a 10% weightage would mean about 20 billion plus, apart from the active investors who have already started coming in.
Yeah, and as you say, we've got a lot of inflows and more to come, but there are still obstacles that face foreign investors. You've got complex documentation requirements, there are tax rules. Are we seeing anything from Indian authorities to try and ease that burden?
Well, the Indian authorities actually have kind of pushed back against offering any particular tax incentives to get this JPMorgan inclusion done. So the inclusion has happened despite the Indian authorities refusing to provide tax breaks to investors for trading on international platforms like Euroclear. So it's come onto a position of strength for the Indian authorities. That's also because India is currently enjoying a good phase of macroeconomic stability with the strongest growth among emerging markets, as well as the fiscal and current account deficits coming down quite significantly, as well as having a strong central bank's inflation focus. So that's kind of made it a darling for foreign funds, with most of the big names from the BlackRocks to the PIMCOs to the Aberdeens overweight in the Indian bonds.
What does it mean for the government then and its finances under this new Modi administration?
Right. So the next thing to closely watch out for investors would be the budget, which would be likely be detailed in July. That comes from the new Modi administration. The key difference of this government is that the Prime Minister Modi's party is no longer a single majority party, and it's in a coalition. That would mean that the sense is that there might be a bit more welfare spending with focus on poor and women and rural areas to alleviate the rural distress a bit. That would mean more spending. So investors are watching out for what kind of fiscal stance the government takes. Though still the large belief is that the government will continue to stick to a fiscally disciplined budget.
All right, that was Bloomberg senior FX and rates reporter Subhadeep Sirkar there in Mumbai. And we'll have more ahead. This is Bloomberg.
All right, markets are doing this here right now. Obviously, we're watching what's been going on in the CGB market. So it looks like this rally has sort of taken a bit of a pause and really digesting these lines coming through from the Lujiazui forum from Gongsheng, talking about how the central bank and the MOF are studying to implement government bond trading. So they're still rejecting, or at least not calling it, quantitative easing, but they're saying that this is going to be a gradual process. But I think it's interesting, though, that they've at least maybe heeded to some of these calls out there that maybe China needs to consider this now.
Yeah, and as we said, we haven't really seen government authorities stepping into the sovereign bond market for a number of years now. But it is that scarcity of low-risk assets in China's financial sector that's sort of obstructing the central bank's plans to try and make its monetary policy toolkit a little bit more efficient. So certainly something that they're going to be watching very closely here, and as well how they plan to do it. We know they're planning to make it a very gradual process, and also saying they need to optimise their sovereign bond sale pace and the tenor structure.
Yep, Nvidia still the big story, though. Another one that we're tracking here and continuing to see these chip stocks benefit from that Nvidia story becoming the world's largest company by market cap. Take a look, Quanta Computer in Taipei. We're up close to 9% gains right now. That's it from us here from the China Show. Bloomberg Markets Asia is next.